Hi everyone, I hope this finds you well, and welcome to this month's webinar. We're going to be doing something slightly different this month. Rather than talking about the monthly news or what's going on with the budget and COVID and things like that, things have actually started to quieten down in terms of the latest news. So what we wanted to do is go back to basics, and what we originally did the webinars for was to try and think of things and ways for you guys to be able to invest without going down the traditional route. So rather than coming to us with a set budget and we recommend something, or going to an estate agent with a set budget and they recommend something, try and think of ways so we can actually add value to your potential portfolios. So we're going to do this webinar on how to invest with either 20, 30 or 40,000 pounds. Now, I'm sure you're aware that you start to reach 30 and 40,000 pounds in savings, it becomes a lot easier for us. It makes our job easier. Obviously, the harder it is, the lower the value, the harder it is for us. But there are still ways. So it's not a case of giving up. There are ways. We just need to think a little bit outside the box. So let's crack on and see what we can achieve with those particular finances. So first of all, we're going to assume a few things. Now, as I mentioned, anything with sort of 40, 50,000 and over, our job becomes much easier. The majority of good buy-to-let properties can be purchased at this level. The way that we assume this is if you've got £50,000, you can typically mortgage up to 4 times that amount. So one question that we get asked a lot is, what's the minimum I need to invest? Well, don't think of it as in a monetary figure. Think of it as a percentage figure. You're going to need 25% of the total property price. There are other variables. For example, if you're overseas, you might need 35%. Certain areas that we've noticed, especially with lenders, the way they're reacting towards COVID, it can go up to sort of 40%. So the more money, the better. But as a minimum, you should be looking at 25%. We have had inquiries before where they've got maybe 20,000 and they want to buy a £300,000 property. It's not going to happen. However, if the lower that your budget becomes, it just means the harder that we both have to work. And the reason I say that we both have to work is because it's not just about us finding the right project. You guys need to go away and do a bit of work on in terms of, we'll come to this later in more detail, but what you can actually save in a certain time period. And again, there are numerous other things that we need to look at when we're looking at the budget. So in terms of this particular webinar as well, we're not going to use it as a big advertising feature. We know people do webinars, and what they do is they present all their properties, and it always links back to, come on, you've got to buy through us. We're not going to say that. This is typically just to give you other options and other thought processes out there. And of course, don't get me wrong, when you buy through us, that's how we make our money, and we would love everyone to buy through us. But the reality is that maybe our structure doesn't fit everyone. So the most important thing is you get what's right for you. And one thing that we also want to take from this webinar as well is it's not just about, we don't look at things like you've got enough money for one property, therefore that's all you're ever going to have in your portfolio. It's genuinely not about that. Our main role here is for you to think, okay, if I have 20, 30, 40, 50,000, whatever it may be, the idea is that we make that money work as hard as possible, and then we start to think about how to extract that money. And so you can move on to property 2 and then repeat the process in property 3. If it's taken you a number of years to save up that money, or if you've been given that money or left that money, whatever it may be, then a lot of people think, well, I've been left that money, I'd never be able to save that amount, so all I can ever do is one. That's not the case. We do say to people, with the right strategy, you can actually invest and then remortgage and pull that money out, or release some equity and then go and do the same thing again. You don't need to keep adding new funds to the pot. And of course, many people start with a lot less than the kind of figures that we're going to be talking about today. So there's another few assumptions as well. Due to COVID, not many people, or a lot of people I should say, who are coming to us at the moment are typically not investors. They've simply found themselves to be investors because they've got more money to play with. What a lot of people think is that everyone's got less money in their pockets at the moment due to COVID. That's actually incorrect. Obviously, there are some like that, but the Bank of England have quoted that there is an extra £250 billion in savings across the UK due to COVID. And that's because the government have been funding a lot of that. People have had mortgage holidays. They've not had to travel, pay for lunches, go on holiday, spend on entertainment. Even things like lunches, you're spending £10 a day on a lunch, £200 a month, 2,400 over a period of a year. Do that over 2 people, you're nearly talking about 5,000 for lunches, plus people's traveling, plus expenses. You'd be surprised what people have actually had to save up. So this has led to the rise of what we call the 20k investor. This is the key amount at the moment where we're getting a lot of calls in regards to the 20,000 amount. So again, this is why we have to think a little bit outside the box. Now, before we jump into the figures, there's a few assumptions that we have to make. Is first of all that you're not restricting yourself to your local area. Now, the reason why we say that is we have so many calls and people say, I've got whatever it may be, 20, 30, 40,000. I want to buy my local area. When we look at the average price in their local area, then you're looking at 400,000. It just doesn't add up. And also, when we look at the average return in their local area, it's like 2 to 3%. So you've got to think bigger than just your local area. This is pure investment. There should be no emotion. There should be nothing about aesthetics, what it looks like. It should simply be about how much am I investing and how much am I getting out over a 5 to 10 year period. That's it. It's as simple as that. Another assumption is that you know your long-term strategy. So, for example, if you've got a strategy that is 1 to 2 years, it's going to be a lot different than if you see a strategy for 5 and 10 years. So what we want to make sure is that you know your exact strategy. Now, that strategy might be, and typically will be, in terms of what the reasons why you are buying. So, for example, if your strategy is 5 years because you've got children who are going to attend university in 5 years, then fine, we can aim for that 5-year strategy. If you've got a strategy that is due to your pension and you want to supplement your pension and you're sort of 50 and you want to retire at 65, then that's a 15-year strategy. So you need to know your long-term strategy and why you're doing this. It cannot be, I just want to make more money than I'm making now. That's not a strategy. That's just pie in the sky. You need to think, right, yes, you want to make more money than you're making now, but why do you want to make more money than you're making now? Not for the sake of it. There has to be an end goal here. Also, another assumption we're going to make, simply because we don't do that, is we're not going to look at commercial property. We're not going to look at garages. We're not going to look at planning, etc. They're all options, and they're all valid options. And what I mean by things like garages and planning, actually purchasing a piece of land and getting planning on it, or buying a row of garages and trying to get planning on that, they're all options. But because that's not our speciality, it's something that we're not going to go into detail and we're not going to look into. We will always advise close to city centres. Again, to invest 20,000 in the middle of nowhere is easily done. That's not the aim of the game here, because again, it comes back to what your rentability is. So we can look at city centres, whether that be first or secondary city centres. And again, we're not worried about aesthetics. We're not going to be looking into details of the apartment and thinking we wouldn't live there. That is not about what we're looking for. We're not looking for things like that aesthetically has river views. Bonus if it does, but that's not our main aim here. The size is irrelevant as well. We have a lot of people talking about, I want a bigger apartment because I wouldn't live in that. Again, you're not buying for you. You're buying to make as much money as possible. And as I say, the last point is numbers are the be all and end all. Now we'll start with the easy one first. We'll start with the 40,000, and then we're going to work our way back. In regards to the 40,000 side, let's work out what we can do. Again, this is going to be different from the norm. So of course you can come to us and we can provide you a property that gives you great returns with 40,000. Very straightforward, because with 40,000, as we mentioned before, you can typically get £160,000, as this is what your company, a mortgage company, will allow. And we've got plenty of options at that level. But as I say, this is not going to be one big advertisement. This is going to be something slightly different. And as I say, the idea is that we're going to maximize your income and growth over the next 5 to 10 years, and we're going to start to pull that money back in for you. So what else have we got? Well, in terms of what a lot of people are doing, is they're actually buying a larger property and adding some extra value in that. Now, that doesn't mean renovation. A lot of people think, well, they're going to buy a rundown property and renovate. Typically, that's already been done. If you've got a property that's good enough and cheap enough to renovate, you're not going to get it. I don't mean that in a disrespectful way, but you're going to have a builder that snaps that up before it even comes to the market. They will have their hands in every single agent out there that the moment they get a below market value property on, which is going to be done up for a builder spec, they're going to be on that and all over that like a rash. So don't think that there's a market for that anymore. What I would say is things like there are some big older properties out there. We deal with a few mill properties, for example. A typical 2-bed will be something along the lines of maybe 550, 600 square foot. There are some 2-beds that we've got hold of which are actually closer to 850 or even 900 square foot. They're huge. Now, what you could do with those is you could actually put up a stud wall and add another bedroom. Some of them are not open plan. So, for example, you've got smaller kitchens, smaller living room. Why don't you knock the wall down as long as it's not structural, and you can sort of open up the living room and open it up and the kitchen, make it off plan. That in turn will give you a far more sellable property or a far more rentable property. Therefore, you're increasing your rent and you're increasing your growth straight away. They're two things that are key there. Also, what I would also say to you is you've got to make sure that it can be done. You can't just go in and start knocking down walls. There's got to be certain parameters that you work in, and I would always speak to an agent to make sure that that can be done. Sometimes you might have to apply for planning, but the key to this is you've got to buy big, and it doesn't necessarily have to be pretty. You just got to buy big at the start. That's the key. In terms of how it's been done before, it's done all the time. So we've got a lot of clients who come in and they put stud walls up, and suddenly they've turned a 2-bed into a 3-bed. They're generating another room, so they're letting out room to room rather than as a whole flat, and they're generating probably 50 to 60% more income than they would have done traditionally because that they're letting room to room rather than as a flat. Now, as we then sort of come on to the next step, it's buying property below market value. You're not going to find this on Rightmove and Zoopla. If it was on Rightmove and Zoopla, there'd be no need for companies like ourselves. The fact is, Rightmove and Zoopla is everything goes on there which an agent can't sell to their initial client base. That's the brutal reality of it. So, for example, if we have a property online, let's say we've got a property and its market value at 300, but our client, again, we're talking hypothetically, but our client says they only want 200. We would always go to our client base first. That's the first and foremost thing that we do. It will get snapped up. If it's a good enough bargain, it will get snapped up. The moment that it doesn't get snapped up, we then put that onto Rightmove and Zoopla. So I would typically say you're not going to get the below market value, the hugely below market value properties on Rightmove and Zoopla. What I would say is you need to sign up with agents like ourselves, let them know your spec, and look for below market value properties. And they don't come around that often. But when they do, you've got to go for them extremely quick. We've had a number over the years where we've got sort of property prices where they're 250, 260, and we've got in just below the 200 mark. And it's really straightforward. So as I put here, if you've got 190,000 property, which you pick up for 160,000, and the market increases by 6% per year, after 2 years, you've got £50,000 of equity in your property. And all you simply do is you pull that £50,000 out and you go and reinvest in the second purchase. And you look to repeat the process. And you're essentially using the same 50,000 time and time again to invest. Now, of course, there's pitfalls. What we have to say is that the property market can go down as well as up. So one thing that you want to make sure is that if that particular scenario doesn't work, then okay, you're still satisfied with the property that you've got. But if you get a below market value property and you are looking in the right areas, which we always say is the north at the moment, that's where the growth is at the fastest, you can actually pull out a great bit of equity and you can use that to reinvest, and you're not having to start saving again. You're not having to start, grinding away at that savings account to get the next property. You just simply pull it out of the one you've already got. So the key to this is how you set up the mortgage at the start as well. What you don't want to do is sign up for a 10-year mortgage on it, where the plan is to reinvest and release equity after 2 years. If you sign up for a 10-year mortgage, you might have redemption fees, and then you won't be able to do that. So it's all about, as I said at the beginning, the strategy from the start. Then the next side is let the property out of serviced accommodation. We've made so many clients have far better portfolios just by switching the kind of tenant. Now, we've got to take COVID out of this because it's been horrendous for short-term lets. But if we typically have taken a normal traditional let, our research has shown that we only need to let a traditional or a property for 33% of the year as a short-term let to get the same value as if we were doing a traditional let. Now that's a huge difference, and a lot of people say, oh yeah, but you get more wear and tear with a short-term let. That couldn't be further from the truth. You don't. It's less, because first of all, the chances are you've got less occupancy rate. You're not going to have 100% occupancy rate with a short-term let, so you get less occupancy rates. Secondly, you know as well as anyone, when you go away, when you go and stay in a short-term let, or you go away for the weekend, or even if you stay in a hotel, you don't live in the hotel. You simply go in, you put your case down, and then you go out. That's the whole point. You're going to an area which is typically not your home, so you typically won't just go from home to home and stay in. Therefore, traditionally, these particular properties that let out on a traditional let where you live in them will have more wear and tear than a short-term let that people just pop in, get changed, sleep, and go out. So I would say that your serviced accommodation not only makes more money on the actual income side, but you've got less wear and tear going out on the outside as well. Also, great tax benefits, has to meet certain criteria. So it has to make sure that it's available for 210 days of the year. You've got 105 days that it's actually let out for, and not more than 30 to the same consecutive person. And then you can benefit from great tax benefits, things like your mortgage side of things, but also capital allowances. This is a big thing. We work with closely with a company, and what they do is they go in and do a capital allowance write down on day one. So what they would do is they will go in and say, well, look, as we're going to let this out as a business or as a traditional let, we are going to go into this property and we're going to say, well, the kitchen, for example, that's going to devalue over a certain period of time, the bathroom, the furniture, and so on. And then they will go and get a certificate from HMRC stating that this is the contents, or this is the price of the devaluation of the internals of the property, and you can literally write that down as tax. So for example, if you've got a 20,000 devaluation and capital allowance, you don't pay any tax until you make above that £20,000. But again, we always say, look, speak to a tax specialist, speak to a company about that before you actually delve in feet first. So as I say, if we went outside the norm and we went with 40,000, they're three of the things that I would look to do personally. First of all, buy a larger property, especially the older properties. They will be bigger than a lot of the newer properties, and add value by either opening up the living area and the kitchen, or putting an extra room in. Sometimes you'll see a huge bedroom where you can actually probably divide that into 2 single beds or 2 single bedrooms, and actually you can generate far more income that way. Secondly is buy a property below market value. Again, sounds obvious, but a lot of people simply don't even look or don't even ask what's on the books. They just come in, they buy, and they don't even think about what is actually out there below market value. And of course, if it's below market value, there might be a few quirks. It might be a waiting game to get involved, but the reality is that they do exist, and then you can release equity. And the third is, of course, how you rent it out by serviced accommodation. So we're now going to move on to how to invest with 30,000. So we're obviously going to keep in mind what we've spoke about on the 40,000, because everything theoretically applies, but it gets a little bit more complicated as we've taken 10,000 out of the pot. Now, one of the big things here that we have to think about is areas, buying in a rundown area. Now, this is a long-term plan. Again, it goes back to what we said at the start. It's all about the strategy. In terms of the strategy, you've got to get this right from the start. If you've got a 2-year strategy, then forget about this particular investment type. It's just not going to work for you. We're talking, again, you've got to be thinking 15 years to potentially 20 years, and that's why we've pulled this chart up here. So whilst this wouldn't be at the top of my list to do, you're going to be surprised how much income and growth this can particularly generate. It's, as I said, it's more of a longer term plan. It's not for the faint-hearted, as a lot of the areas that are run down now might have headaches with them, but it depends on how strong your gut is basically, and if you can follow this through. So take areas such as Hackney, Brixton, Hoxton, Shoreditch 20, 30 years ago. If you held a property there, you would have made a huge increase in your investment. So we've got the map here, and you can see the percentage what these particular areas made. So you've got Hackney from 96 to 2016, it made close to 700% growth. 700%. Even Hounslow's on there, 452%. But if you look at more of the rundown areas, and a lot of people think, well, City of London, was that really expensive? Not for residential, great for obviously commercial, but not for residential. A lot of these areas are rundown areas, and they all increased over your 600% mark. 690 for Hackney, 666 for Southwark, Lambeth 639. So a huge increase in more of the rundown areas. And actually, if you pick up certain pockets in these areas, there will be certain pockets within Hackney that would have made even more. There was one particular property that I remember seeing that went from something like 70 or 80,000 to well over £1 million over a sort of 13-14 year period. But as I said, it's not for the faint-hearted. It's one of those that you might have to stomach. But again, if you use a company like us, we do all the management for you. We take the headache away from it. But the key is trying to work out where the government and where the local councils are spending that money. And that means you can buy cheaper, and therefore your 30,000 can make an impact. But importantly, the growth over the medium to longer term especially is phenomenal, is key. Then we start to head the further north. Again, a lot of people that we have for investment come from overseas, or they are predominantly fixated on sort of like London, and that's the first thing they think of when they think of investing in the UK. But guys, the key here is the further north you go, the cheaper it becomes. We've been promoting the north for 6-7 years, give or take. We had London, we did well in London, but the key to us is really trying to get as much money into the north as you can, because if you buy an £800,000 property in London, you can go and buy 4 in the north. It's not as strong as it was 5 years ago. The case for investing in the north, it simply isn't as strong because the market's gone up there. But there are still some great pockets, and the north will give you far more bang for your buck than the south. Again, if we look at secondary cities, although that they're not going to have the same amount of pulling power from your perspective as the major cities, there's still great investments to be had in this area. So, for example, when we talk about secondary cities, obviously primary city centres, your Manchesters, your Liverpools, your Leeds, your Sheffields, they're your primaries. Then there's always secondary cities off of that. So for Leeds, you've got your Bradford. For your Manchester, you've got your Preston. And there are great options in these particular areas which can generate really high income. And again, a lot of properties in these areas also have the added combination is that some of them are really big as well. So what you can do is you can buy that big property, you can put a room up in there, an extra room or a stud wall, and then you can start to rent it out from there, and they will have some fantastic growth in that particular area as well. So that's definitely something to look at. Head further north and speak to your broker about other secondary cities out there where you can invest. Will you get as much income in those particular areas in the short term? No. But if your budget simply doesn't stretch to it, then look, there's great growth to be had. So that'd be more of a growth strategy as well. Now then we head to the 20,000. Now this, guys, is where it becomes really tricky. What I would say is before the 20,000 side is it might not be the case that we immediately go in headfirst into a property. It might be the case that we have to do a lot of work behind the scenes to get you to that stage. So the first thing that I'd say is it really comes back to you. You've got to work on strategy. You've got to work on budgeting for this, and you've got to work on exactly how much you can save per month. Now, the reason why we do that is because if you can save per month, and everyone goes unrealistic on this, we send a lot of these sheets out where we send budgeting sheets out, and you have someone that, let's say for argument's sake, their take home is 2,000 a month, and they turn around and they say, well, actually, I think I can save 1,500 a month. The reality is you can't. By the time that you paid your electric, your gas, your food, your mortgage, there's no way out of 1,000 or 2,000 you're going to save 1,500 a month. It's best to be realistic. And there's a lot of other little fees that and other costs that people don't take into account. They forget about their phone, or they forget about their Sky, and they then put themselves under financial pressure. So that's not what you want to do. What I would say is if you're in this category, ask us and we'll give you a real detailed financial planning tool where you will actually put every little niggly bit in. Even if you go out for a coffee, if you think you have 3 or 4 coffees a month, put that down, because 3 or 4 coffees a month, well, suddenly that might be £100 a year. So that's definitely one to take into consideration and have a look at. But again, we can help you with the financial planning. So again, we're going to assume for this that you've already done that. But the reality is that you need to do this, because if we can work out to the penny how much you can save over a period of 6, 9, 12, 18, 24 months, it then really helps us in terms of getting you the right product. Because what we can do is, if you've done that, we can then think about buying something that is off plan 2 years away. So if we've got something that's off plan 2 years away that only requires 10% now, well, theoretically, you could go and buy a £160,000 property and you only need £16,000 now, as long as over the next 24 months, you can realistically save that £1,000 a month, for example. If you can't, let us know what you can save, or we'll work out what you can save, and then we'll fit into that strategy. We've got stuff that's off plan for 3 years, 4 years, depending on where we buy. So what we can do is we can actually say, you know what, if you need 4 years to save up, no problem. But the big advantage is you've secured the price now. The moment that you reserve is the moment that you've secured that price. So Savills, for example, estimate that the property market should go up by 25% on average, or 28% on average, sorry, in the northwest over the next 5 years. Well, if that's the case, rather than waiting 5 years because you think I'm not going to be able to save for 5 years, we buy something that's off plan now, and you get the price effectively 28% cheaper than if you would if you bought in 5 years' time. So we say to people, look, off plan obviously has its pitfalls. It's obviously something where you have to wait. But if the reality is that you've got the £20,000 and the only option is to wait, then it's the 100% recommendation to do. But you've got to make sure you can save up. So I've seen so many people invest, exchange, and then don't get right on with their savings. And what happens is they then get to, being a year away from completion, they suddenly panic. What you've got to do is you've got to make sure, and you've got to be so strict with yourself and save month on month, and literally do not touch that account, because that is part of your investment. So that's definitely an option. And if you want that budgeting tool, we can get that over to you. And if you want things that are further down the line rather than sort of your typical 12 to 18 months, let us know and we can find those too. The next option is team up with someone else. We have a lot of this where people ask us to put in contact with another typical investor of around about the same level. And what you can do is you can structure this legally, where you set up a company and you have 50% of the shares each. And then what you simply do is you can then go and buy a property that you both agree on with those 50% of the shares each. And then the big advantage is you've now got double the clout financially. The upside is self-explanatory. It means that you can get onto the property ladder quicker. You can start earning money a lot quicker. And don't forget, with the property, you're not just making your income on the 20,000. You're making income. So if you've invested on 160, if you team up with another investor at 20,000, you've actually invested 160,000. So your growth, if you make 10% growth, you've made 10% growth on 160,000, not just 10% on your 20. If you make 6% income, you've made 6% income on your 160,000, not 6% income on your 20K. And again, we've got to look at what happens if you left that in the bank. If you leave 20,000 in the bank and you make 0.5% on it, well, you can imagine the difference between leaving it in the bank or actually investing. So there's a huge difference. So we say to people, look, team up with another investor, whether it be friends, family, ask us and we can put you in touch with people that want to be contacted. The majority of the clients who have approached us, as I say, around about the 20,000 mark. So there are a lot of people in the same boat as you, and two minds are better than one. You'll do double the resources, double the research time. And again, it actually creates a nice buzz, and you can get 3, 4, 5 people involved. But the idea is that you're getting to your end goal a lot quicker. So they're the two factors. Without having properties that are priced at around sort of 80,000 mark, it's really tough to invest with 20,000. But there are two major options. One is buying off plan. Requires, let's say, something that requires only 10% down, but you've got the savings capacity there. Secondly is team up with another investor. Put the feelers out, ask us, speak to friends and family, because you might have someone else in the same boat that's close to you that actually wants to do the same thing, but just simply doesn't have the capability financially, but two of you can. So guys, you should have sort of like some questions and answers. In terms of the next steps, any questions, just feel free to ask. I think you either have a speech bubble or a question mark there. Just let me know. We've had a couple so far. One said no sound, so I hope after the last half hour you have had sound. otherwise I might have to re-record this. So yeah, I hope you did have sound. In regards to the question about putting people in touch with each other, that's we've had quite a few on that. So how do we put people in touch? If you just email me at the bottom there, you'll see an email at the bottom. Just let me know, and I will put some people in touch with each other. Of course, there's data protection, so what I'll have to do is I'll just have to make a few phone calls. We'll do an introductory call all together, and then you guys can sort of swap numbers or swap email addresses if you feel comfortable after that call. I won't just sort of be sending out everyone's number, but I'm more than happy to do that. I've got here, if I wanted to buy a property through a limited company, can I tie up with another limited company as a 50-50 share? Yes, you can. Of course, that will all go through the legal paperwork. It would just simply be two entities on the contracts. Like you may have two entities as in two people, you can also have two entities as in limited company. So for example, if you had a limited company and your friend, family, or even another investor through us had a limited company, you can then both have those on the contracts as 50-50 partners. Where it becomes slightly tricky is when it becomes to mortgages, because obviously what you have to take into account, and we always say this, is make sure you both do your due diligence on each other, because when it comes to mortgages, what you don't want to be doing is you're contributing to the mortgage and the other party isn't, and then it can get a little bit tricky. So there's a few more legal ramifications that we have to overcome. But they are workable, so it is definitely something something worthwhile. Next one, do we have any properties where they're in secondary cities and large? We did, if I'm honest. We don't at the moment. We did. We had a couple of cities where they had some huge apartments where we could put stud walls down, but they were snapped up pretty quick. But again, if you just email me, if that's the route that you wanted to go down, more than happy to start looking, and more than happy to start putting the feelers out, and I'll assign you a broker as well. If you go on to our website and our Meet the Team page, you'll be able to connect to anyone on there. So feel free to choose your broker. All the brokers are equally experienced, doesn't matter their ages. We've got young brokers, we've got older brokers. They're all really well trained up. They know exactly what they're doing, exactly what to recommend. But importantly as well, they run all the decisions in terms of where to recommend past the management team first, so we can ensure that there's kind of like some form of quality control. They're not just recommending something that doesn't fit, so they'll always run that past us as well. With regards to chasing for opportunities, is checking Flambar website as effective as checking up on individual brokers? Good question. No, it's not. Some of the properties that we have, we increasingly so now, and I'll explain why in a minute, but we can't actually put them on our website. That's not due to inefficiency, it's just that the policy of the developer, and the reason why comes back to mortgages. So a lot of mortgage companies, the first question they ask is, what's the makeup of the purchasers? So for example, do you have more residential? Do you have more buy-to-let investors? And what they look for is a higher rate of residential investors. The reason being is they feel that if you're going to negate, or if you're going to not pay your mortgage, you're more than likely going to not pay your mortgage on your buy-to-let property. So it's unlikely that you keep your buy-to-let and let them repossess your residential. So what they say is, that it's more of a risk, hence why you have to put down 25% rather than your 10. So what a lot of the mortgage companies are saying is, actually, if it's a highly investable product, well, we're not going to lend on it. So, but there will always be lenders, but not typically sometimes your mainstream. So what we then have to do is not put it on our website, because a lot of developers don't want it to be seen as a highly investable product. And the moment it goes on an agent's website like ourselves or another investment company, that's the automatic thing that they think, that it's only investors, which is not the case, but that's what they think. So no, it's always best to contact your broker, and it should be your broker's job actually to contact you, but yeah, it's always best to contact your broker. Next question, do we only deal with apartments or houses as well in secondary cities? Well, we do deal with houses. We have dealt with houses before. However, typically we would say that houses don't perform as well as apartments. At the moment, the actual results are skewed. We've got to be realistic. COVID has meant that there's been a real high increase in demand for houses because everyone in the city centres who was working there decided, do you know what, I don't need to rent here anymore. I'm going to go out to the suburbs where I get more space, more of a garden space, and far more bang for my buck. But that's going to change. We're already seeing a change now. Rightmove and Zoopla are reporting an increase in city centre apartments. People can only commute for so long, whereas they haven't had to commute. Everything's been rosy, but a lot of people now are realising that the commute's back on. I mean, I travel into London daily. Apart from today, if you can hear my dog in the background, so apologies. But yeah, I travel into London pretty much daily, but I actually drive in. Now, it's been great for me. It takes me 35, 40 minutes to drive into Canary Wharf. However, this week, I've noticed a big difference. Me leaving at, so for example, I left on Monday, yesterday at 6:30 in the morning, and it took me about an hour and 20 minutes to get in. Whereas typically it's been taking, so around about 35, 40 minutes. So I've noticed a big difference. More people are going back into the city centres. So I will personally say that we will be back to the norm pretty quickly. So I would say, look, you know what, houses make money. There's no getting around it. But typically, if you're renting out a house to a family, you're renting it out to a family that can't afford to buy a house. If they've got to that stage where they can't afford to buy a house, not all the time, but typically, you might find that they've got kids, they might not take care of the property, and there's so much wear and tear. We've got a huge amount of houses that we've dealt in the past, and they're really hard work. When people leave, they have to change carpets, there's whatever all over the carpets and walls. Whereas when we rent out an apartment, we typically get young professionals who literally sleep there, go to work, and they just take care of it more. Again, not all the time, but the norm is that we have less wear and tear in our apartments than we do with our houses. And there's always someone on hand to carry out some work. So if something goes wrong or something needs doing, there's always someone on hand in an apartment, where with a house, it's slightly different. So that's why we predominantly recommend apartments. And you've only got to look at the best buy-to-let cities globally. Forget UK for the moment, but globally. And the capital cities, the growth in the cities that's been the best growth over the last sort of decade, and the best rent have all come in capital cities, whether that be London, Paris, Berlin, Hong Kong. It's all capital cities that would have had the best and the most expensive real estate in the world. Again, would typically be your capital cities, whether it be your Londons, your New Yorks, wherever it may be. So that's why we always say city centres is probably key. The only downside of apartments outside of the cities, apartments is you've got a ground rent, but the government are going to change some legislation on that. And I don't see ground rent being an issue for too much longer. As long as you get minimal ground rent that's £250, whatever it may be, increasing in line with RPI, none of this sort of like doubling every 10 years. How do you publish new opportunities? Is there a WhatsApp group? Good question. There's not. If you the reason why we don't do it on a WhatsApp group is there's been issues with WhatsApp with GDPR before, that everyone can see everyone's details. So we tend to stay off of that. In terms of new opportunities, again, if you just let me know, if you send me an email with your details, we can make sure you're on the list. We typically do it via email because then it's a bit more unique to you, rather than everyone having your details. So it will always pretty much be over email that we do that. Aren't flats or apartments bad value due to ground rent service charges? Okay, yeah, going back, sort of just extending on what I've mentioned a minute ago. Yeah, so with apartments, you do have ground rent and service charge, but it's a myth that you don't have costs associated with a house. If you've got a house with a garden and it's empty, or the current tenant isn't taking care of it, you've still got external costs. So for example, you've got house insurance that you have to pay for. They'll pay for contents insurance, but you've got to pay for house insurance. Again, the service charge covers that. Things like your windows, the repainting of the house, you're going to have to repaint the exterior. You're going to have to make sure the garden's maintained, the driveway. Again, that's all included in your service charge. Yes, okay, you've got your ground rent, £250 a year, less than £1 a day. It doesn't eat, as long as you've got a low ground rent, it doesn't eat too much up into your particular property. But we just find that flats and apartments, as long as they're in the right location, have far more occupancy rates than houses, because typically The majority of people, they either graduate from university, they go to work, and they rent, and then they rent a city centre apartment. And then once they start to have relationships, have kids, then they start to move out and they start to buy when they've got actually a family and they've got kids and they want a garden. Either people that can't afford to rent, they have to buy. Apologies. People who can't afford to buy, they will buy cheaper houses, and therefore they might be in more of a rundown area where they don't take care of it, and that's not the kind of tenant that you want. So as I say, there are still costs associated with houses that people just underestimate. Could you use Telegram instead of WhatsApp, where the data is protected and can't see the details of others? Do you know what? I've not looked into that, but thank you. I will. I'll have a look into that after this. Is there more of a conscious effort now for brokers to do due diligence around EWS1 forms and cladding issues prior to pitching new opportunities? Yeah, there are definitely. We've had instances where we've looked at the legislation, and the legislation has been okay, but the mortgage companies haven't actually carried out the legislation. They've just been a law unto themselves. We've had a particular project in Manchester where the legislation states that it doesn't need an EWS1 if it's under 18 metres. The moment that people have gone to get mortgages on it, some mortgages have gone through, no problem. Other lenders have said, no, we want an EWS1. So then we've had to go through the process of removing cladding and replacing it, which still hasn't been done. And it's taken far longer than expected due to banks getting involved and the developer being pretty slack, if I'm honest. But yeah, the reality is that now what we're saying is any product that we get put across our desk, the first thing we ask is, does it have an EWS1? And if it doesn't have an EWS1, or there's a chance it's going to be asked for an EWS1, we won't look at it. We've got one in Liverpool at the moment that's just been put on our desk. It's all concrete, so they can't ask for an EWS1. But yeah, more and more lenders are now really requiring this EWS1, to the point where we had a development complete recently, and it completed after the 2018 regulation. So it completed in 2020, just before the lockdown. And actually, that particular development, it didn't need an EWS1, just simply because it would have only been signed off if it had no cladding. It simply wouldn't have been signed off by building control and by the council if it had cladding after 2018. But the lenders still asked for an EWS1 on a handful of the mortgages. So we had to get someone to come in, do an EWS1, which said it's got no cladding because it's been signed off. But there's real lack of thought process going on at the moment. It's a good question. An EWS1, guys, is key. So I would definitely say, yeah, make that an integral question. Does it have an EWS1? With regards to serviced accommodation, it looks like that some lenders don't always allow that. What's your view and the best way to approach it? Yeah, you're right. The mortgage market is always well behind the reality. So, for example, if you wind back 10, 15 years, you would have only had a smaller number of buy-to-let mortgages available, because it wasn't the norm, 10, 15 years ago for the majority of able to invest in buy-to-let. You'd only had, I just remember when I was at school, if someone had if a friend's parents had a second property, for them, or for everyone at school, it was like, wow, you must be really wealthy. But now it's more of the norm to have a buy-to-let. The same with stocks and shares. The internet, the information age, has been able us to do our own research. So we're not just relying on so-called experts in the stock market. So people have had more access to those particular properties. So yeah, the mortgage market is behind, but it will catch up. So at the moment, there are something in the region of 2,800 or 2,900 buy-to-let mortgages available, but there's a lot smaller number available for serviced accommodations. You will have to use specialist lenders, a bit like your buy-to-let mortgage. It's going to be going to a mainstream lender for a traditional buy-to-let will be a little bit more tricky. The same thing with serviced accommodation. We'll have to go to a non-mainstream lender, but they are out there, because what you've got to look at is you just go on Airbnb, you type in a certain area in wherever it may be, London, Manchester, Liverpool, Leeds. All of those have got mortgages. So you've got to ask yourself, how are they getting mortgages? Now, some of them will have a normal residential or normal buy-to-let mortgage, and they will be letting out through serviced accommodation means. Well, that's up to them. Some lenders will say, well, if you get a normal traditional buy-to-let and you decide to then let it out short-term let, you have to let us know. Some won't. That's something you've got to read in the contract of the mortgage. But I can pretty much bet your bottom dollar that those particular properties on Airbnb, they don't actually have the full serviced accommodation mortgage. But there are more and more lenders coming to the market as the lending market plays catch up to the reality. But it's a good question. Look, guys, I think that's out of questions. I'm more than happy to answer anything. If you want to contact me via email or phone, it's at the bottom of the screen. Any of our brokers would be happy to talk. So look, guys, from me, thanks for listening. I hope you have a lovely rest of the week, and feel free to get in contact, anything you need. Take care.